So what we're going to look at today is predominantly footprint. Okay, we're going to focus a lot on the footprint. The reason is because the example we're going to use today is showing a confluence of things. It's actually been a really good example of footprint action, if we're going to call it something. Okay, some traders call it price action. I'm going to show you what really good footprint action looks like. I'm going to show you how the story was very well told. Okay, and in fact, as we get into these principles, I think one of the most important things to be able to differentiate between is when the market is telling a good, clean story, a story you understand, a story you can interpret, a story that really gives you some sort of a bias understanding as to where price might be moving. And then sometimes the markets tell a really bad story, or a really sort of convoluted story, or a really muddled story. It's very important as a trader to be able to differentiate. Okay, sometimes the markets are going to be what we term as easier to trade. Okay, sometimes they're going to be very difficult and choppy and nonsensical to trade, and it's very important that you differentiate, because in that you're going to start to find where your edge is. Okay, if you're someone that's someone that likes to trade sort of distribution ranges, who likes to fade the ranges, etc., then those kind of markets will make a lot of sense to you. If you're someone who's a trend follower, okay, then trend following will make sense to you and seem easy and seem logical. So make sure you can differentiate ultimately where you kind of fall between those two spectrums. Okay, so where we are today, we're going to talk about 4 principles, then I'm going to bring you onto the charts. Now, as mentioned, this is very much a confluence footprint stream. So I'm going to show you, these elements, these principles in one day on the Emini S&P 500. Most of you trade it, so do be switched on. It's a particularly interesting day that we had on the 16th of August, so Friday the 16th of August. Okay, so the first thing is to understand what volatility is. Okay, again, you should know what this is. It's very important you do know what this is. In last week's Extreme, I explained to a lot of you that the best way to interpret volatility is when we have a simple increase in the range of prices over which we trade. The best way to do that, just simply get a daily ATR. Okay, so get a daily ATR that's going to show you the range every day, plot a nice moving average on it, and when that slope, okay, note, when the slope is starting to increase, that's when we have volatility beginning to increase. Now, do note, there's a caveat to this. If you use too short a time frame for your moving average, i.e. a 5-day, it's going to look like this. Not useful. If you use too long, i.e. an entire year, it's going to look like this. Okay, so use something that can move with the ebbs and flows of the market. I would recommend using some form of an exponential, and also look at least towards maybe a 1 month. Okay, there's 21 trading days in a month, roughly speaking, so either use a 21-day, which is a monthly type average, or go a little bit longer, being quarterly, so 63-day. Make sure you use EMA, exponential. Why? Because it has higher weighting towards the most recent data points. Okay, so the first thing to understand is that when there's volatility, right, you have to adjust your approach. You have to make sure that you're aware of what volatility is going to do to your strategies, your approach, your stops, your risk management, all these kind of things. All right. So it's important to know when volatility is increasing, when volatility is decreasing, and when volatility is just flatlining. Okay, perfect example. If I get one up, if you're trading, for example, the cable at the moment, let me just get the cable chart up for you. Okay, so if you're trading up cable, I'm just going to show you what this looks like. You will notice that at the moment the volatility in cable is pretty nonsensical. Okay, if I just scroll this out, you'll see that in the beginning half of the year, volatility, obviously the volatility line we're looking at is this white one, guys. So in the beginning of the year it was relatively high. We were trading 100 handle ranges, 100 pip ranges, and ever since April, May, i.e. when Theresa May stepped down and the Conservative Party began the process, what's volatility done? Okay, it's gone down. Now, that's hopefully very interesting, because all you've read about in the newspapers the last 2, 3, 4, 5 weeks is Brexit, blah, 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 volatility is increasing. Actually, hang on a sec, no it isn't. Volatility is definitely not increasing. Okay, so that's why we have these volatility indicators. Alright, then the next one is the concept of initiative. Okay, initiative is where a large time frame participant enters the market and initiates. So the price action is very obvious. In other words, a buyer comes in and he lifts prices, he lifts the best offers, he's quite aggressive, intentional. He's intentional in what he's doing, and he continues that intention. Okay, initiative is not this. Okay, one candle followed by a lot of overlap, followed by maybe that, followed by some pullback, followed by that. Initiative is lacking in overlap. In other words, it's very one directional. There's very little price pressure in the opposite direction. Okay, large market orders is exactly what they say. It's large orders transacting over a small number of prices. Okay, and I'll show you what this looks like in a minute. And then imbalances are just simply where we have untraded or low volume areas. In other words, when a market bids up or offers, okay, so when it bids up, it struggles to trade much volume over a series of prices. So what happens in essence is the market bids, we have a low volume area over there, it bids again, we have a low volume area over there, it bids again, we have a low volume area there. In other words, these are areas where there's very little contracts traded, very little lots or volume traded. Okay, we want to be aware of these imbalances in the market. Why? Because at some point they're going to fill out. Okay, those are 3 basic concepts. Now, let's get on to the example. As I said, it's the 16th of August. We're looking at the 16th of August in the S&P 500, and I'm going to get the chart up for you now. So what we're looking at is not that one. What we're looking at is that one, and we want to go over there. Okay, so what you're looking at is a 15-minute time frame. So it's a 15-minute footprint chart. Okay, now I'm going to take you to the start of the cash session. Now, if you were trading the market overnight, let me actually just show you what that looked like. So if we get the S&P up, okay, I want to just show you and deliver a bit of context to you from the previous session. You can see the previous session was very much a sideways session. Okay, so the market went down to these 18s and came up to the 72s. Right, that was our range the previous day. Now, very interestingly, we can see the market very swiftly rejected 18s, but equally swiftly rejected 72s. Okay, so the battle lines had been drawn from 18s to 72s. No one wanted to be a seller below 18s. No one wanted to be a buyer above 72s. Right, Asia opened. That's this line here. So Asia opened, came up, tested those 72s, and struggled initially. Went up above it. Okay, but notice the reaction there. Very little interest, right? This is all pre-cash. Very little interest to be above that line, 72s. Right? Cash market just before cash, we came back into that range. Cash opened, and we drove out. Okay, now that's important. It's very important here because a lot of people just say, "Oh, there's support at 28.72." Rubbish. Okay, just because the market stops, it doesn't mean there's support, resistance. Doesn't mean there's resistance. Okay, we have to go look at the interaction. We have to physically go and look. What did the buyers and sellers do up there? Okay, was there interaction up there that tells us that yes, actually, the sellers did get out, the buyers were initiating, in which case the 72 is relevant or not. And that's what we're going to explore today. That's what we're going to look at. Okay, so let's get back onto this chart. So we're looking at the footprint here, and in essence, what we're looking at is, that's not the footprint, that's the footprint. Okay, so we're looking at a 15-minute rotation, and this is the open of the cash. So we can see cash market opens with this green line. Okay, each one of these is a 15-minute rotation. Now what's very interesting is right off the gun, bang, buyers stepped in. Okay, they stepped in very aggressively, but they were lifting very heavy offers. Okay, and that's interesting. It's important to note that the buyers stepped in, but they lifted very, very heavy offers off of the open, and we can see that with a very high delta. Okay. The market then settled. So we settled, volume dropped off. In other words, the market almost became uncertain. So we had that initial buying impulse, note above yesterday's high. So that brown line's yesterday's high. So we got initiative above there, but again, the market failed to sustain that price. Just like it had done in Asia, it failed to sustain that 28.71. And we hung around for the next almost, half an hour. The market just rotated. But what we started seeing, and if you look at these dark colors or these yellow bars, we started seeing a lot of volume transacting. So a very high volume, very high concentrated area of volume trading. So a lot of two-way trade. Right? So remember, buyers initiated, and then we saw a lot of two-way trade. Okay. Finally, once we got a confirmed close, so you see the green here, we got a confirmed close above that 71.75. As soon as we got that confirmed close, what did we do the next rotation? Okay, again, bang. Very big volume, 111,000, 3 times the previous rotation, and the market auctioned all the way from 70s up to 83s, 13 handle rotation. Okay, very significant. However, note, flat delta. Right, now that's quite unusual because what we should have seen is we actually should have seen quite an aggressively bid delta. In other words, what's happened here is the buyers have gone aggressively up, but then the sellers have gone aggressively back down. Right? So again, very much two-way trade, not much initiative here, just one directional. Okay, yes, price drifted up all day, but it's not a case of buyers were fully in control. Okay, and we can see that again with this little block here. So we call this a high volume area, so a high concentration of volume. Right? If you go and look at this, this is almost, if you know, in a space of two handles, you've almost done 30,000 contracts. Okay, so large offers, large sellers sitting around that 28.81 willing to sell. Right? So again, the market backed off. And that same point, note, that same high little pocket of volume that we had on the open, which was 72s to 75s, notice how that now turned into support. So the market came back, tested that high volume area, and pivoted back up again. Okay, now note, the next rotation, this rotation at 345, notice the low comes in and tests again this high volume pocket of volume, and again pumps back up the page. Okay, we then again run into these yellow volume pockets. Note the volume pockets. Okay, market comes back down, and what does it test? Tests the lower volume pockets. Goes back bid again. What does it test? The higher volume pockets. Comes back down, tests the lower volume pockets. In other words, the market is trading between these high volume points. Okay, these points where buyers and sellers are interacting. Right, it's been a fascinating session. In essence, what's happening is the market's going bid up. It runs into liquidity, as we saw here, runs to liquidity, and suddenly the buying stops, and the sellers enter, and it backs all the way off. Okay, the buyers then recharge. They go bid up again. They take it all the way up. They find those sellers. Once they find those sellers, they back off again. They release the bid, and the market drops off. And obviously, they go back bid again. They find those sellers, and they back off. Okay. That's been the price action today. It's been a case of bid up, find liquidity, and back off. No trend, no, be long aggressively. It's simply just play between where those pockets of volume are trading.